buckle up because we're about to go through an inflation playbook, how to invest if there's going to be a lot of inflation or a little inflation, or how to diversify your portfolio. And if you want to learn how to build your wealth after you see these principles, make sure to check out the links down below for the amazing program. So you get 39% off using the coupon code TOTHEMOON. And folks, let's get started with the video.
Hey everyone, me Kevin here. So on Tuesday morning at 8:30 a.m. Eastern time, which is 5:30 in the morning my time, consumer price inflation data for March comes out. And folks, a lot of people hate the consumer price index. In fact, most of us watching this are probably like, dude, come on, man. The CPI is like the lie of the government. Just look around, man. Prices are going up. Like, so what? The stats don't say there's inflation. There's inflation. Just go out into the real world. Leave your studio for once, right? Like, totally agree. Yet the reality is all of us on Tuesday are going to be like, oh, what is that CPI data going to say? Well, folks, I wanted to talk about exactly this and some ideas and some projections and how to invest in potentially inflationary times, but also invest in ways that would benefit if inflation doesn't manifest as high as we think it will. So first, I wanted to start with this was a really contrarian piece on inflation that I thought was really good, actually. This was in the Financial Times on Thursday. Inflation offers escape route from debt crisis. And so this here says, it basically is setting up, look, we've been printing money like crazy. Every country in the world pretty much has been spending money like crazy to spend their way out of the COVID pandemic. We've printed 25 to 30% of the money that exists in the world, and the money keeps flowing. I mean, you've got Joe Biden, who's running an over $4 trillion deficit, plus the fact that now we're going to have this additional potentially $2.2 up to $4 trillion infrastructure plan. Remember, the $2.2 trillion, that was just the first half of the plan. But anyway, so he sort of sets the stage that, look, folks, how can there not be freaking inflation coming? Okay, this is nuts. This is absolutely nuts. And so here we go. He talks about how governments were basically in the past forced to take unprecedented measures to avert a 1929 style depression. It's basically, let's spend our way out of getting into depression. We don't want to be in a depression. But then he says, for the entire house of cards not to collapse, though, because countries have taken on so much debt, he says that, quote, growth and inflation need to be restored. It is the only way to repay the debt legacy of the crisis. And this is an interesting argument because generally when we think of inflation, we think bad. But wait a minute, think about one of the positive externalities of inflation. Watch this. So let's assume you make $50,000 a year. If you make $50,000 a year and you have $20,000 in debt, that debt level doesn't go up or down, let's say. That means for every $1 that you earn, you have about 40 cents of debt. But what happens now if you get a pay raise because there's inflation, or you get better at doing what you do, you become more efficient, more productive, whatever. You get a pay raise. Well, 50 turns into 65 with a 30% increase. So that means now when you were previously making $1, you're currently making $1.30. There's that 30% increase. Well, the cool thing about debt is even as you make 30% more, let's just say it was all due to inflation, like you're the same productive worker, you didn't get any better at your job. Let's just say it was all inflation, okay? In the extreme that it was 100% inflation as to why you got a 30% pay increase, your debt is still $20,000. So now you have 40 cents of debt for your $1.30, which before your debt was a 40% burden on the amount of money that you had in a year. You made $50,000, 40% of that could have gone to pay off your debt. Well, now all of a sudden you make $65,000, and 20 divided by 65 is actually only a burden of 30.8%. So your debt burden went down because you're making more money. And this is intuitive. The debt stays flat and your income goes up. The debt is easier to pay off. So really what this author is arguing is that, hey, if we have growth, if we have productivity and people making more money and earning more money and inflation, well, now debt stays constant and your pay can go up for two reasons. One, inflation,
but also if you become more productive, your pay can also go up. And so this is how inflation and an increase in productivity can really help us quickly accelerate burning off debt. It's like throwing gas into a fire of productivity. Yeah, let's run a little hot. Let's run with a little inflation, but let's also increase our productivity fast, and we're gonna make this debt look like nothing. We're gonna cakewalk it away. The problem is, this does hurt some people. Mostly it hurts fixed income folks. So for example, if you are retired and you make money off bond yields, like bond coupon payments, well, unfortunately, unless you're investing in something like TIPS, which are treasury bonds that adjust to whatever inflation is, your money is going to be worth less. And this is where a lot of folks get frustrated. Like, wait a minute, like I worked for my $10,000 in treasury bills, let's say, and now if the government's just gonna make everything run hot and inflate away the debt, that's not fair to me. That's not fair to people who have invested in debt. It's not fair maybe to lenders, and maybe it's also not fair to people who are saving. But it does also encourage people to go, okay, well, I may as well not save, I may as well invest. So you have this really weird sort of give and take when it comes to inflation and productivity. But this individual here is saying that, look at the situation we're in right now. Low interest rates, a ton of money printing. At the same time, savings rates are at all-time highs like we last saw in the mid-1970s, which is also when we left the gold standard and had a crap ton of inflation. We're not talking a little bit of inflation, we're talking like 9 to 15%. And so this author makes the case that, here's the thing, all of the recipes exist right now for big inflation and big growth, which is gonna be good for debt. Like we need that to burn off all the debt that we have. But he's giving a warning to say, you gotta be prepared, because when that inflation comes, you wanna be investing properly. Now, he gives advice for exactly what he recommends, which we'll talk about in a moment, but I wanna read this quote. At the outset of the crisis, the Fed's bold action, including large-scale financing of government debt, was timely. Now, it is hard not to see it will lead to a de-anchoring of inflation expectations and a revival of the specter of 1970s-style growth in prices. In English, look, we needed to spend the money to survive, but now we're starting to realize, okay, this is gonna be a little bit of a problem. We're gonna have some big old time inflation, and so we gotta be prepared for it. In fact, he says, quote, "We believe this might be the case again with the rest coming after the summer, once economic data reveal the true health of the U.S. economy and its inflation path. The Fed's role in distorting asset prices is set to diminish as market forces reassert themselves." In other words, everybody was relying on the Fed last March, and the Fed bailed everyone out. Now, the Fed's got to step out of the way, and he believes the market's going to force the Fed out of the way. Market's going to take over. And that's what we've already started seeing happening in February, in March, when we've had this big pullback to price in inflation because folks are gearing up, ready for that inflation to come. And so, before I mention what he talks about investing in, I'm going to talk about what I would potentially recommend investing in. I think it's very interesting to note that, yeah, in some sense, having higher inflation, while it does diminish the value of your dollar, if you're invested and you're a borrower, you win. And this unfortunately accelerates that K-shaped sort of wedge we have in society, where it's harder for people who don't have assets and businesses and then debts against those to get ahead, because inflation hurts them. Inflation makes it harder for them to survive on a day-to-day basis, or to get that new computer, or to start that business, right? All their startup costs go up with inflation. It's really just people who already have wealth who really benefit off inflation. But he says it might not matter. Even though it might not be equitable to see inflation coming, it's coming, and you got to prepare for it, because the Fed's not going to have control of this. The genie's out of the bottle, so to speak. So now let's talk about where to invest in these potential scenarios. But to do this, I also want to give you my projection, and then we'll compare where to invest. All right, so first, my projection. So this is my thought on how the consumer price index might move. And I understand this is not exactly the best measure of inflation, is just one arbitrary measure that we have, but this is what I'm going to chart with. So we already know 1.3 and 1.7. These numbers already came out for January and February as annualized rates. I think in March, as in the data that comes out on Tuesday, I think we're going to see a really nice bump. So we're going to really see this acceleration in inflation, and it's really going to be its worst in April. And the reason I see this is just looking at the base effects of where we sat last year. What was the base we sat at last year? And this is why we see this big bump of inflation, because we had a hole last March, April, and May. And so then I think we're going to slowly unbury ourselves from this. And we will see higher inflation, but we might not see this genie out of the bottle style inflation that we're worried about, or at least some of us are worried about. Now, I'm going to talk about investing in both scenarios, but take a peek at this. There is also the possibility that we do have a form of inflation that just does something like this. And this could potentially lead to this higher style inflation that many folks are worried of, that we might run over to 4, 5, even 6, maybe 7% inflation. I'm not sure many folks, I'm sure there are some, but I think most people would say if we're going to see higher inflation, it might be around these 6-7% ranges, maybe not as high as we have previously seen, like that 10 to 15%. But I think that's an alternate scenario here. So I think these are the two scenarios here. You've got either inflation going up, and I'd say maybe this range right here, kind of this little middle section here, I'd say that's probably our 95% likely range right here. That's sure, is it possible that we'll see lower or higher? Of course, but I'd say this is probably the 95% that we should be thinking of. And obviously you could draw your own chart and think of your own 95%. And then if we were to say, okay, well, what is a middle probability here? Well, I think it's going to bias a little bit to the lower side. And so personally, I think this right here is about 50% probable, being somewhere below 3.5% inflation. And then maybe this section over here also has like a 40-45% probability of maybe running a little hotter than that 3.5%. But that gets a little bit more arbitrary, where we think things are going to go. I think the better thing to do here is to decide, okay, how do we invest in these sorts of environments? And so the first thing that's useful to consider is what happens to different asset classes. So what happens to stocks, what happens to Bitcoin, what happens to real estate. Well, so with stocks, generally what happens with inflation is high growth stocks. So anything that's growth with inflation, we tend to see with inflation, high growth stocks go down in the short term. So I'm going to write short term. And that's because we're really eradicating future potential earnings with inflation. We're devaluing those future earnings because money in the future is going to be worth much less to us. But in the long run, growth stocks can still do very well. It just takes longer term. And the reason for that is inflation does ultimately lead to prices going up. Even in deflationary tech, if we do have a lot of inflation, we would expect to see prices going up. And those earnings in the future and projections for future earnings should go up. And so in the long run, we should see growth stocks also do well in inflation. In the shorter term, we have other stocks, and these are oftentimes considered the value stocks. Value stocks can be whether they're financials or industrials or recovery stocks. Oftentimes now when we think, okay, we're going to have a growth, we're going to have inflation. So we'll draw this here and say value with inflation. Usually in the short run, these guys do very well because folks say, well, we don't want our future growth getting eroded away, so let's just park our money into value stocks or just stocks that look cheap today. At some point in the future, though, we'll see that rotation back, and so in the longer run, in my opinion, we could potentially see value stocks will still do decently. I think they'll still kind of go up and to the right, maybe not straight up like growth might in the long run. But I think we're going to have a little divergence where you will see highly indebted companies, even with inflation. I think they're still going to suffer And so they're probably going to trend down a little bit more, especially as things in the long run rotate over to growth. Even though inflation makes it easier to pay off your debt, these particular companies in an inflationary environment, which could also potentially be a really hot economy, might end up suffering to the burden of the amount of debt that they have, and they won't be able to catch up with growth. Growth will outpace them so quickly. So in the longer run, very, very bullish for growth to do very well in the long run. Value in the long run, I do think will go up, but at a slower pace. And highly indebted companies will probably trend down over time with inflation. This is the with inflation scenario here, right? And then in the short term, growth is what really gets hurt, which for some who are willing to be patient about it can see that as a buying opportunity. But anyway, that's usually what you end up seeing in an inflationary environment. Obviously, if there's no inflation or low inflation, well, then that long run for growth will just come faster, and we'll see that increase in growth stocks much sooner than we would if we had to go through sort of an inflationary cycle. Because this high inflation won't last forever. At some point, even if we went to high inflation, we might end up just Paul Volckering down. And if we do Paul Volcker down, there is also the possibility of a short-term depression where companies go through painful deleveraging. And this is kind of exactly what we see here, where that painful deleveraging would probably lead these highly indebted companies to go bankrupt. And growth will survive because many of the growth stocks are just not highly indebted. And so they'll end up coming out the winners either way. So in either scenario, when it comes to stocks, for the long run, I mean, it's one thing if I wanted to momentum trade, I can momentum trade some of these trends. But for the long run, I really want to be in the growth, because with or without inflation, in the long run, I think I'm going to do very well on the growth plays. And so that's an expectation that I have. That's sort of my theory on stocks. Now, what if we run over to Bitcoin? Instead of stocks, let's call this Bitcoin. So with Bitcoin, the two scenarios would be inflation or not, right? So we'll put or not, inflation or not. So obviously in an inflationary environment, well, I shouldn't say obvious. I ran a poll on Twitter, which follow me on Twitter at RealMeKevin if you haven't yet. I ran a poll and I asked why folks invest in Bitcoin, and about 48% of you said you invest in Bitcoin as an inflation hedge. And so I do think that Bitcoin does stand to do very well in an inflationary environment. So if we get that higher inflation, I do think Bitcoin will do very well, especially if more corporations put some of their treasuries, the cash that they have or cash and equivalents that they have into Bitcoin. It's very likely that in an inflationary environment, we could easily see Bitcoin 5 to 6x, $300,000 to $360,000 per coin is not unheard of. Of course, there are many folks who believe we could see Bitcoin $1 million, we could see Bitcoin 500K. Certainly Bitcoin 100, I think, is within the radar. And this is, of course, barring any kind of massive debt crisis that ends up coming out of a rehypothecation crisis in the crypto lending market because of a lack of governance. And, we don't know where all these loans are going and how often loans are being made. So there could potentially be a debt crisis in cryptocurrency, which would just be very bad for cryptocurrency all around. But aside from that kind of debt crisis, I do think that inflation is going to help push Bitcoin, we'll draw this a little bit more clearly, to $300,000 to $360,000. Now, if we don't see inflation and we do start getting this decline of a run here, which I expect the decline to really start taking hold somewhere around June or July, and that's really when we'll see this inflection point where either we'll maintain that higher inflation or it'll go away, which I do expect that it'll go away. Not only because those base effects will be gone, but I do think supply chains will repair themselves over time. And it does take time for supply chains to fix themselves. But remember, supply chains have been repairing themselves now, or been trying to for over a year now. Or at least in June or July, they will have been for over a year now. Because supply chains really got damaged in March and April of last year. And now we're starting to see some of the effects of that, the shortages, chip shortages, lumber prices, real estate prices so high that lumber is so high, right? And other real estate inputs are so high. So now if we do not see inflation, I do worry that one of the big reasons, almost a 50% reason for people to be investing in Bitcoin evaporates. There are, of course, many other reasons to invest in Bitcoin, but if inflation goes away, it's possible that as growth stocks start taking off potentially more than Bitcoin does, And let's say Bitcoin, this summer hits 100, it is possible that it could, in an uninflationary environment, either trade sideways or stagnate a little bit in value. So I'm not here to prophesize that, Bitcoin's going to zero. I just think for a trading and momentum mindset, if we do see this sort of downtrend in the chart here where we start going down, I do think Bitcoin potentially will suffer in an environment like that. Whereas obviously I think it'll do very well in an inflationary environment. Okay, then let's touch on real estate here. So then we have real estate. So with real estate, it's a little bit of a double-edged sword. So with real estate, what I really want, because there could be a lot of pain in real estate in a high inflation environment, but let's talk about this. So in a high inflation environment, what's really going to win, the winner, and there's really going to be a limited style of winner here, but the person who wins with high inflation in real estate is the person who has long, fixed rate debt and cash flow to cover. See, the beauty of long fixed rate debt is in an inflationary environment, if we do see this high inflation scenario, we'll expect interest rates to go up substantially. And you'll want a fixed rate loan so that your payments don't go up, and you want it to be long so that your payment doesn't balloon or all of a sudden become due and payable at a time when you have to refinance at a substantially higher rate. That would be bad. So variable or short-term debt is definitely more at risk in real estate. And not having the cash flow to cover the payments on these debts would also be an issue. So you want enough cash flow to cover and service your debt, and you want that long fixed rate debt. That way, if we do have high inflation and we end up getting interest rates to go up, remember the rule of 10x, if interest rates go up 2%, real estate prices could go down 20%. There could be a large adjustment in real estate prices downwards in an inflationary environment. However, even as real estate prices adjust downwards in a shorter term inflationary environment and rates go up for a few years to sort of control, put the genie back in the bottle, so to speak, control that inflation, anyone who's able to ride out that storm is going to see their debt become a whole lot less valuable, which is a benefit, a partial benefit of seeing inflation. Their debt will become relatively cheap compared to what they have now. And so this is where, with high inflation, real estate investors could really win, or anybody with debt could really win. Now, personally, I do not encourage debt on Bitcoin. I think debt on Bitcoin is bad. It's very volatile. I think any more than 20% debt, so anything greater than 20% debt on stocks, I think that's bad. Margin calls are bad. Margin calls in Bitcoin are also very bad. But debt in real estate is actually very, very good. And so there is this argument that it might make sense, if we do expect larger inflation to come, it might make sense to invest more heavily in safer real estate debt. Maybe buy that house, get that long-term fixed rate debt, buy that multifamily building and get into the real estate market so that your debt gets worn away in an inflationary environment. Now, if we don't see that inflation and rates do not go up to hurt real estate prices in the short term, because in the long run, I still think real estate prices, even if we go through a short-term, high rate environment, in the long term, I think real estate prices are likely to continue to increase, and not forever. I mean, I do think that there would be a substantial amount of pain. Don't get me wrong, with high inflation, but I think in the long term, anybody who can hold on to the real estate will benefit substantially. But the point is here that if we do believe we are going to go to this higher inflation environment, we would benefit from either momentum trading value stocks now or riding the pain in growth stocks, because growth stocks are likely to do well in the long term. So you'd have to really be able to time your exit on those value stocks, or certainly at least the recovery, highly indebted value stocks that look like value right now, but that are really value traps. With Bitcoin, you want to be aware of the momentum as well, because if we start getting that inflection point to the downside as well, I think there could be some softness in Bitcoin pricing. And then real estate, unless you have cash flow and you could cover this long fixed rate debt you have, it's going to be very risky to take on short-term debt, because we could see a dramatic decline in real estate prices in the event that interest rates go up substantially to combat inflation. But someone in the long run is really going to win in that sort of scenario. So I'm going to give an example here. Let's say somebody has a $300,000 house and they take out $200,000 of debt. Let's do it in red here. $200,000 of debt. And so now we have interest rates go up, 2, 3%, whatever, and the value of this real estate comes down to, let's just make an example here, 200K. And the value of our debt goes down to 200K. So now we've had real estate prices go down, but in order to see this, like in this case, like 3+% increase in interest rates, or potentially even more, the person's still able to make their payment, they're not getting margin called, whatever. Yes, some equity has gone away. But what is a benefit of a higher inflationary environment? Well, you have debt, so the amount of money that you're working for, your income should be increasing in an inflationary environment. The productivity of any of the goods or services you're producing or commissions you're receiving or whatever should be going up in an inflationary environment, as long as we're also in this booming economy, right? And if we're in a depressionary economy, well, that could also be a potential issue as our income goes down. Or our productivity goes down. But nonetheless, we're not forced to sell, and what's happening every single month is we're still paying off this debt. And whether we're getting paid more or tenants are getting paid more, inflation will make those older dollars less valuable. So let's say we go through a period of 5 years of inflation, and we end up having, I don't know, let's go with 6% inflation for 5 years. Okay, so if I do $200,000, or let's say I make $50,000 of money. Okay, I want to $50,000 of money is what I make, and we go through 6% of inflation-adjusted wage increases. 1, 2, 3, 4, 5. And that puts me at about that $67,000 income. So now I have $67,000 of income where previously I had $50K, and that's 5 years at 6% inflation. The same is hopefully going to be true of my very qualified tenants. So it's actually very likely that an inflationary environment could foster rents to go up. See, even though prices right now are going up so parabolically, rents are not keeping pace right now in many different areas. Don't get me wrong, rents are up, but they're not keeping pace. And that's really because it's just more affordable to buy, so more people are buying, inventory is low, less people are selling. So you're seeing this big wedge, at least in the areas that I'm looking at, you're seeing a wedge in what prices are versus what rents are. Like, rents are not keeping up with home prices right now. But in inflationary environments, when wages go up, but maybe real estate prices don't go up, you can actually ironically see inflation push rents up. And if rents and incomes go up, your income, your tenant's income, that debt becomes substantially less valuable. Like that example with the $20,000 credit card we made earlier. So then, of course, after an inflationary environment has come and gone, as long as you've held on to your real estate, and then interest rates come down, well, now your income is higher, your tenant's income is higher, your rents are higher, but your debt is still denominated in those really old dollars, which are worth a lot less now. So to me, trying to figure out a balanced portfolio in this environment between real estate, Bitcoin, and stocks is the big challenge. Now, this particular author here, he argues that the return to inflation could help ease the debt burden, but it will be hard to swallow since it arbitrarily transfers wealth from savers to borrowers. Exactly. It transfers wealth from savers to borrowers. We don't like borrowing on stocks. We will not borrow on cryptocurrency, but we will borrow on real estate for exactly this reason. As an inflationary hedge, real estate could operate very well, especially since real estate prices oftentimes do ride on the inflation curve. So if this is what inflation is here, real estate prices often either match it or ride slightly above it. And then you benefit because of leverage in real estate. But anyway, this particular author says that investors need to prepare themselves for this shift by seeking value stocks rather than chasing new fads. So this particular author encourages the value stock argument. I encourage a little bit of a balanced portfolio. So I want to give these bottom lines here. So if you are a momentum trader, I think recovery and value, and even Bitcoin could be good momentum. But you're going to have to be careful here because that momentum could shift quickly, especially at the point of this inflection. If you are a real estate investor, you really want that long fixed debt, and you almost, and I know this sounds crazy, but you almost want as much of that as possible because in an inflationary environment, you're going to win. And if we don't see a lot of it, and this is even if prices go down, you're holding for the long run, right? Your goal is to eradicate that debt not to try to flip the property. It's not like you're going to buy real estate and go, oh, I'm going to try to flip this for a big profit because prices only go up. No. I am warning that prices can and will go down in an inflationary environment. But your goal is to eradicate that debt so that when you come out on the other side, you're coming out like a bandit because you've got really, really cheap debt. Yeah, I mean, your rents are up, your income's up, whatever. So long fixed rate debt on real estate is going to, in my opinion, be good in both scenarios. So you win in high inflation, you also win in low inflation. The momentum trades, they'll work short term, but you have to be aware of these changes. So Bitcoin recovery, value stocks, be aware of those. The one that's going to hurt the most, in my opinion, is really going to be growth. But it's only going to hurt in the short term. And that short term is either while we experience inflation or while we anticipate inflation. Because obviously, if the inflation woes go away, then we would expect to see lower inflation. So those are the three ways that I advocate investing and sort of diversifying in these inflationary or potentially inflationary times. The biggest thing that I'm doing, just to be transparent, is I'm about 4% Bitcoin. I'm about 50% real estate, and then about 46% growth stocks. So that's my breakdown. And so you can see I'm really taking a strategy that's heavily focused on the long term. I would not be in growth stocks if I was not in them for the long term. And I wouldn't be in real estate if I was not in them for the long term. I would be tempted to flip out of my real estate. I'd be tempted to flip out of my growth stocks in the short term if I was solely doing momentum plays. And then Bitcoin, I'm keeping an eye on as a momentum play. And then sure, I might mess around with some momentum trades and things like that. But it'll be a small part of my portfolio since, again, we're about 50% real estate, about 46% growth, and then that 4% sort of momentum. This is the more entertaining part right here, right? But my longs are very, very strong. So anyway, this gives you my inflation playbook and why inflation might actually be a good thing for people who have assets. Unfortunately, everybody who doesn't gets screwed, which is, the mission of my channel is to make everyone who watches my channel realize that if you don't have assets, you get hurt in this country, unfortunately. And if you want to learn my perspectives on building your wealth, make sure to check out the programs down below on building your wealth with real estate, with stocks, or sales, or YouTube, or property management, you name it. Links down below, and folks, we'll see you in the next video.